Welcome everyone to the ICMA webinar, the Asian International Bond Markets Development and Trends Report. We will begin shortly. Please allow us 1 to 2 minutes to allow others to join, and we will begin the webinar momentarily. Thank you for your patience. Hi everyone. For those of you who just joined, we welcome you to the ICMA webinar on Asian International Bond Markets. We will begin in about 30 seconds. Greetings everybody. My name is Mushtaq Kapasi. I am Managing Director and Chief Representative for Asia Pacific for ICMA. I'm very honored to have with me today my colleague Andy Hill, who is Senior Director and Global Head of our Secondary Markets and Repo Practice at ICMA, joining from London. Hello, Andy.
Hi, Mushtaq.
Great. Well, for the next hour or less, we will be presenting the recent report issued by ICMA on the Asian international bond markets, covering cross-border issuance from entities located in Asia to investors globally. We'll be going through some of the main themes, findings of the report, and a few of the more interesting data points. But this will only scratch the surface of the vast wealth of research and charts that are located inside of the report. And we very much welcome you to browse or even read or analyze or criticize the final report that we issued a few weeks back. It is freely available on our website. You can Google or get it from our website, or my colleagues have helpfully put it on the chat. So you can go to the chat now and you can actually click that link to access the report itself. So we will have a short slide presentation. It will just give some of the highlights of the report, and Andy and I will maybe have a bit more of an informal color behind some of the stories, behind some of the data. We very much would appreciate any comments, questions, and suggestions that you may have on the report. And so we've also posted the team email for the Asia team at ICMA, apac@icmagroup.org. And you can email that, that address if you have any feedback on the report that you would like to share. So we won't be sharing the slides, but just a bit of housekeeping that we are recording this webinar. So there will be a recording available for yourselves or any other stakeholders who are interested. It is a public recording, so feel free to share it as you wish. The paper is also public, and you can just download it at the link. Now, in terms of the logistics for this call, your line will be on mute during the entire call. But if you have a question, we'd love to hear from you. And we will do our best to answer questions live as they come in. Although if it becomes a bit unmanageable for us, then we may leave some of them until the end as well. We plan for the presentation to take about 30 minutes around. So if there are a number of questions, we'll have plenty of time. If not, then we can just end the webinar early, and you can always reach out to us after that. And so to ask questions, you will just go to the Q&A function in the Zoom. So you look down by participants and the various icons there. There's a Q&A button that should allow you to submit Q&A through that Q&A function. And then Andy and I will be able to look at that. Okay, well, let's get started now. Actually, before we get into the report, I would just like to do a few thank yous, if you don't mind. First of all, to HKMA, Hong Kong Monetary Authority, for their great support. Really, they were the ones who had this idea to do this study, to fill a gap in knowledge in the market 4 years ago. And it's really through their help and support that we've gotten a very large and interesting data set on primary market issuance that we've been able to analyze, and also through their thematic support, helping to understand some of the issues that are mostly of importance to the markets, and particularly Hong Kong stakeholders, that helped us guide our research and guide some of the questions that we have. So really big thank you to HKMA for your support. We would like to emphasize, though, that the report itself, the comments in the report, although we've taken a large number of feedback from various market participants, the opinions, the data, the analysis are completely owned by ICMA. So this represents our own institutional views. Okay, I'd also like to give great thanks to the other institutions that have provided data to inform our report. In alphabetical order, those are Bloomberg, Covalent Capital, Dealogic, Equiland, IHS Markit, and Market Access. And we'll be highlighting some of the data from various of those organizations in the slides to come. Okay, let me now move on to the slide presentation itself. Please bear with me as I move to that. Okay, so just to start out, let me set the scene here and tell you about the scope and the methodology of the paper. So first of all, the scope. This does not cover all of the bond markets. It does not cover all of the credit markets. It does not cover all of Asia Pacific, in fact. Okay, so we're very precise here. We are looking in terms of geography at Asia, so it includes Japan, but does not include Australia and New Zealand. When we look at bond issuance, we're looking at international bonds. So the overall data set we were talking about for primary market issuance comes from Dealogic. So it's the Dealogic raw data that informs most of the analysis that's been done in the report. By international bonds, what is meant, in roughly speaking, is bonds that are issued by an entity in one country or a company in one country to investors outside of that country. So it's really a function of where the home country of the issuer is and where the intended marketing is for the end investors. So that's as opposed to domestic issuance. The data from Dealogic was received by ICMA in very raw form, very huge kind of big data set, and we basically analyzed that and made some nuances along the way. So there is some analysis that is produced by ICMA, including things like making some judgment calls on debut issuances and where an entity might be located, things like that. So there has been a little bit of processing from ICMA, and when Andy and I will be talking about some of the narratives behind the charts and the data, and you'll see some of the narratives in the report as well. This is all informed by qualitative input from market participants. What I mean by that is simply interviews. So we did more than 20 interviews, as well as a number of other conversations more informally, where we took notes from issuers, investors, intermediaries, regulators, infrastructure providers, in particular, trading venues as well. So we took all of that market commentary from leading participants and put some flesh, I would say, and some meaning around the data analysis that we did. So we hope that provides a very interesting perspective. All right. So let's finally into the meat of the data. The headline numbers are not on this chart, but I can give those to you. So in 2023, the overall international bond issuance from Asian issuers was 380 billion US dollars equivalent. That's 2023. That's slightly up from 371 in 2022, but of course far down from what we saw in 2021, which is 626 billion US dollars, which was the high from 2006 and probably the high during history. Now, this first chart, it doesn't give you the full flavor of Asia, but what I think it does show, interestingly, is that Asia still remains a very small portion of overall international bond issuance. So what this chart does is it takes global international bond issuance, right? So cross-border issuance from all different regions. How much of that is from Asia? And Asia has consistently remained about around 5 to 10% globally since about 2014. Before that, it was even less. Now, the rest of the world, you see that U.S. and EMEA are pretty significant. Another thing to notice, from this chart, which is somewhat interesting, is that while European and Asian issuances remain relatively flat from 2022 to 2023, the issuance from the Americas has gone up, and that's really driven the increase in overall international bond issuance from Asia over the last year. But I'd like to just highlight one other data point, which is in the report, but not here in this particular presentation, which is thinking about the proportion of overall bond issuance that is international, right? So if an issuer is issuing a bond, they have to they can make a choice, right? They can issue in their domestic market, or they can issue overall in the international market. And how much of that issuance is going to be international? Well, if you run the numbers, interestingly enough, in the world, it's about 35 to 40% on average that is issued internationally, that is issued cross-border. Whereas in Asia, it's about 15 to 20% over the last 5 to 7 years, and it's even less than that beforehand. So in Asia, what that says is that there's a preference for issuing in local domestic markets, bond markets, more so than the global average. Now, why is that? It's an interesting question, but I think the main reasons that we've gotten from our interviews is that unlike other markets, perhaps in Asia, the local markets are very close knit. The commercial banks are very well capitalized and very liquid, and so from a corporate perspective, it's just easier to get funding locally onshore, and so there's not as much of a need to tap the onshore markets. The second reason is that the corporates, especially, and some of the financial institutions in Asia, tend to be more domestic in nature, and so their funding needs are more local, and so they'll fund in bonds in local currency rather than needing to go offshore. But interestingly enough, this proportion has remained relatively stable over the last few years. Okay. Now, I'm going to go into some of the...
Sorry, Mushtaq.
Yeah,
I hope
sure.
you don't mind me jumping in. I just wanted to ask a question. In terms of the issuance, could you say a few words about the currency mix? Is it... I'm assuming it's
yes,
primarily
sure.
US dollar issuance, but maybe you could add some color to that.
Well, yes, it is, but there are a couple of interesting nuances there that came out of the data. So when you're talking about cross-border issuance, right? So of course these are bonds that would go to another jurisdiction, so you'd expect them to be more in the international currencies, which is generally the case. So we found that in 2023, about 70% of issuance was in US dollars, but the second most popular currency for international issuance was actually renminbi. So this does also count dim sum bonds, so going from one jurisdiction to another market. But 11% renminbi and 9% euro was the third currency. You'd expect perhaps more of yen, but yen was actually only 1%, as were some other currencies like Aussie dollar, Hong Kong dollar, and so forth. So yeah, actually mostly US dollar, but not as overwhelmingly as one might think, and probably not as much yen as I would have expected. In terms of renminbi, it's also notable that the dim sum bond market, while still relatively small, had a pretty big increase year on year. So it went from 18 billion US dollars in 2022 to 34 billion of issuance in 2023. So still relatively small compared to the overall market, but in terms of year-on-year increase, quite significant. So yeah, thanks, Andy. Actually, good question. Okay, so here we are. Take a closer look at some of the countries here. So we won't go through all of the countries that are considered, and some of them are very, very small in terms of their markets, but I'll highlight some of the more important ones. So China, you see the story is not a surprise. Huge growth from the early 2000s, from almost nothing to fairly, not dominating, but leading the market in terms of country of issuance by 2018, 2019. Then a very significant drop from 2021 to 2022, which has actually continued to fall in terms of issuance. the sector that has suffered the most is obviously property, and I think it's fair to say that most of that decline has been caused by troubles in the onshore market, which, by the way, have also affected the financial sector issuance, which had been it actually has always been the sector of the most issuance, but probably gotten the second most attention after the property market. However, I think it doesn't necessarily tell the whole story. And one theme that came out of almost all of our interviews, frankly, was that the China story is not just about the property market, and frankly, it's not really about the geopolitics either, which seems to be a factor that is in the back of people's minds from a bond investor perspective, but not necessarily a deciding factor, and not something that is maybe unlike other asset classes, perhaps not something that is in large part affecting behavior of bond issuers and investors, at least according to our research. But what does is the rate differential, and we'll get into that. I'll get into that in the next slide, in a very beautiful slide. But I think we shouldn't underestimate the just basic market forces of price and cost, and these are the main forces that that basically underlie all of the other micro factors affecting each of these markets. So that's one, I think, large lesson that's come out of our research to date from ICMA. So that's China. Japan, actually interesting story as well. So you've seen the issuance from Japan rise over time, but what you can see is that it was already relatively robust, even almost 20 years ago. So Japan used to be about 50% of the Asian market. Now it's somewhat less than that, but it's still fairly significant. And just in the past year, it's actually gone back up, which sounds slightly strange, given that rates have risen in the West. But I guess it's not as strange as you might think if you think of Japan as another developing economy. And the factor that may have mostly explained this recent increase is simply the cost of funding for Japanese borrowers. With a weak yen, favorable cross-currency swaps, the cost of funding, just because of market forces in international markets, becomes attractive and opportunistic. And I think for those reasons, many Japanese issuers, especially large financials, took advantage of the opportunity to tap the international market rather than the domestic market, which is already quite liquid and large for them. Okay. So this next slide, I have to admit, I love this slide. It's just a very, very interesting slide. I'll run through it a little bit. So this is from Bloomberg, by the way. So thank you, Bloomberg, for providing this useful data. This gives a little bit more insight into what's happening in the Chinese markets. And I think, to my view, really opens up more, it shows things are not necessarily as black and white as you may seem, and maybe raises more questions than it answers, which I think is a helpful thing for gaining more wisdom. So just to explain this seemingly complex slide, the green line you see is the basically net investment into China. So this is inflows of foreign capital into Chinese bond markets. And I have to give a caveat. This is the onshore bond market, right? So in a sense, we're looking at different markets. Still China, still issuance from Chinese issuers, but this is the onshore renminbi market. Right? The yellow line is in the rates differential. So what that means is how high are China rates compared to U.S. rates. So it's basically comparative yields for China. So as rates for China go up, you may expect investors to have more demand for China paper because they're going to get higher yields. And that's kind of the story that you see at the 2020 area of the chart. And then as the rate differential goes down, the flows start to go outward. But then you see, interestingly, you see the rate differential continue to go down through the end of 2023, yet then there's spikes in inflows of capital. So why is that? And I think it's a good question. And maybe Andy can give a little bit of color. But my initial thoughts on this is that, well, I think one conclusion is that there is still interest in Chinese assets. So the Chinese market is not dead. That's one thing that's quite clear, that you are seeing investment into China in recent times, although we unfortunately don't have the data for recent months. The second thing, and maybe I'm just, this is perhaps more of an educated guess for myself and a couple of others I spoke with, is that the inflows represent more about rates expectations. So if you think that the rates are going to the rate differential is going to go back up, then, or U.S. rates are going to go down, then maybe that's a good time to buy Chinese bonds. That may not have been a great trade, but that might be explaining this. So yeah, I don't know if Andy had anything you wanted to jump in on.
No, I think, and something we'll touch on a little bit in the secondary part, but I think definitely make the point about anticipating maybe yuan appreciation and the potential for higher rates could have driven this. And I think that there's also a link with some of the onshore flows, but we can touch on that in a little bit.
Okay, great, thanks, Andy. Okay, just to look at a couple other countries briefly. Well, ASEAN is a sub-region, so ASEAN is actually a very important sub-region for Asian issuance, and we've seen that the issuance has been spread across different jurisdictions, but it really is significant. The main issuing countries have been Philippines, Singapore, and Indonesia. Philippines with one major multilateral development bank, of course, which is a major issuer, and their combined shares of issuance have been about 3/4 of the sub-region since 2006. And in 2023, we've seen that the markets have continued to drop a little bit. This has largely been explained by, again, not any quirky domestic pricing or credit mechanism, but simply by the rates dynamics and the fact that the onshore markets have just been more attractive for the corporate and financial issuers in ASEAN. South Korea is a slightly different story. So, like Japan, South Korea has increased in issuance and is the third largest country in terms of issuance after Japan and China for 2023. The story here is it's not necessarily one super clear reason why South Korea has been attractive, but I think there's a general consensus that it's kind of a safe place to be, a known entity, and some very large and well-known issuers have come to the market in 2023, which have led to the increase in issuance. Okay, let me talk a little bit about sustainable bond issuance, which I think is quite significant for Asia for several reasons. One is that Asia probably has the most need for investment in terms of renewable assets and other types of technologies to address climate change. So that's one. Secondly, I think Asia is at the forefront of transition finance, which is actually transforming the economies and the corporates to be more environmentally friendly. But also, looking at the data, one very interesting pattern that comes out is that in terms of international bond issuance, sustainable bonds are a more important part of that for Asia than for other parts of the world. So what I mean by that is, if you're going to be issuing in the international markets, if you are an Asian issuer, then you're more likely to actually issue a green, social, sustainability-linked bond than you would if you were in some other region. Sustainable finance is more attractive, therefore, for international Asian issuers, even if they're not necessarily for domestic Asian issuers. Now, just looking at the issuance by country, actually look at the overall numbers, and you'll see very clearly that over the last 3 years at least, the issuance of sustainable bonds is in line, roughly speaking, heuristically speaking, with overall issuance. So there's a high correlation between sustainable issuance and the aggregate of normal issuance. We so as bond markets go up and down, so will sustainable bond markets. The proportion of sustainable bonds is still going up, but not significantly in the last couple of years. China continues to be the main source, but Korea and Japan are also quite important. And then one happy story is that Hong Kong actually had a doubling of the international sustainable bond issuance from 8 to 16 billion US dollars. Excuse me. So here's one last slide on sustainable finance, and this is illustrating my earlier point on the attractiveness of sustainable issuance for international issuers from Asia. What is this chart telling you? Okay, let me walk through it. So basically, if you take any country, how much international issuance has there been for that country? Okay, and then of that international issuance, how much of that international issuance has been sustainable? What has been green, social, sustainability-linked bonds? And so you see that I think, as much as I love Laos and Uzbekistan, the issuance levels there have been actually so small that the percentage aren't so meaningful. But for Hong Kong and India and South Korea, I would say it's somewhat meaningful. And so you see that in Hong Kong, India, and South Korea, 50, and 30% respectively of the international issuance was labeled as green. And this is compared to only 12% of the global average. And also Asia is still much higher than the global average at 21%. So that means that out of the overall Asian international bond issuance, 21% of that was sustainable, and globally that number is only 12. So it just goes to show that not necessarily that sustainable bonds are more important in Asia or that there's more issuance of it, but that for international issuers, sustainability is actually an important consideration. And why is that? I think the main reason would be investor demand, right? So if you're an Asian issuer looking to get international investors to buy your instruments, one way to do that and to make your bonds much more attractive is to make them sustainable. And international investors who may not be looking directly to Asia are much likely to look to Asian issuers if the issuance is sustainable. So that's, I think, the lesson from this data. One last slide for me, and then I'm going to hand it over to Andy. So this is from Covalent Capital. So thank you very much, Covalent. And to me, again, somewhat counterintuitive data point here. Maybe I've been in Asia too long, perhaps. I used to think that Asian issuance goes abroad to the US and to Europe and to Reg S issuers and so forth. But the data from Covalent Capital actually show otherwise, that more than 50% of investors in Asian G3 issuance, this is looking just at G3, and probably if you put in RMB, it'd be even more, are actually from Asia, with the rest from EMEA and the US. So some very interesting data here, and there's some other charts from Covalent, which you may find interesting in the report. Okay, that's it for me on the primary market side. And now I'm going to hand it over to my colleague Andy to share some of the highlights on the secondary markets in Asia. Andy, over to you.
Yeah, many thanks, Mushtaq. Before I kick off with the first slide on secondary, just a quick reminder that we do have a Q&A function. You can see that on the foot of the page. So please do feel encouraged to put forward any questions. And if you're shy, you can do that anonymously. We look forward to receiving your questions, which we'll try to address at the end. So with secondary, pretty much in line with the primary market. Secondary market activity and volumes have seen a steady decrease from around about mid-2020 to mid-2022. Well, and from 2020 to mid-2022, we saw a steady increase, but since then we've seen a decline particularly with respect to non-financial issuers, very much in line with the primary market. I mean, partly this can be attributed to changing market conditions, and we can see the trends very clearly here of higher yields and also widening credit spreads. But if we move to the next slide, I think it becomes a lot clearer. Sorry, if we could move to the next slide. Yeah, then it becomes a lot clearer that the most significant influence on secondary activity is a strong correlation with primary issuance. And this makes a lot of sense. Corporate bonds tend to be most active in the secondary markets in the first days and weeks after issuance, or as a result of a name-specific credit event. Reduced supply also results in a stronger inclination for investors to hold on to existing holdings, with fewer opportunities for switching to new issues. Participants in the interviews also point to the relative decline of Chinese international issuance, along with volatility spillovers into the wider Asian market, which is, you can see, noted in notable in the decline in market activity at China issuance as overall proportion of secondary activity.
Andy, just a quick question for you though. When you talk about you have secondary market trading volumes, are there any other measures of liquidity that you look at? How do you actually see liquidity in this market, and how have the participants? How have market participants in the interviews generally characterized liquidity conditions in the Chinese market?
Yeah, that is the challenge, trying to measure liquidity. As you mentioned, Mushtaq, obviously we look at relative activity, we look at trading volumes as a time series, we look at activity compared to primary issuance, but it's really very difficult to measure liquidity. And if you think of liquidity as being, if you take the ICMA definition using the 3 dimensions, it's essentially the ability to trade a larger than average ticket without relatively quickly without moving the market that much. So trying to get those data points is pretty difficult, although we do rely a lot on qualitative feedback. And actually I guess there's two interesting observations. Now I think of it. One is, and we heard this repeatedly, that despite the drop in activity and the reduction in primary issuance, liquidity is still generally pretty good. For most names, or particularly in the IG sector, being able to get two-way markets is still possible. Sometimes the bid-ask spread might get a little wide. Trading size up to 20 million. Both sides of the spread can be relatively doable, but maybe more so for the more liquid IG names. So we're talking financials and other sectors such as telecoms. The other interesting observation is that we heard through the interviews is that the structure of liquidity, provision, and consumption has also been impacted, particularly by the China story. And what we see is that the large international banks, they're still very much the main source of secondary liquidity across all the various sectors and countries of risk. The bigger regional banks provide market making in their relevant segments. However, where we've seen a retrenching is with the Chinese banks and broker dealers, where these have moved from a risk-taking model more to a principal agency type model, where they're not taking risk onto their books. And this is largely off the back of losses from the volatility driven by the meltdown in the property sector. But also on the consumption side, we've seen a lot of international investors, perhaps with the exception of those with emerging market mandates, also retrenching from investing in Asia. And again, this is either because they've been burnt in the past 12 to 18 months, or they're simply scared away by the volatility.
Well, sorry, I want to push you on the spot, Andy, because that gives me another interesting question that I didn't plan to ask. Is how do you compare? You said about EM investors. how do you compare some of the trends that we've outlined in Asia to perhaps other emerging markets around the world and other regions? Do you see a reallocation to other emerging markets, or do you see similar patterns in terms of the rate differential in other emerging markets in other global regions?
I think definitely, like, I mean, the two drivers I think are very much, and you've touched on these already. One is the rate differential, which clearly with US dollar rates moving higher has helped, but the other is volatility. And I think we have seen more broadly, apart from, again, investors who have an EM mandate, perhaps just become a little more cautious with regards to EM, rather than, and particularly maybe more yield focused rather than necessarily spread focused.
Understand. Okay, thank you.
Actually, moving on to the next slide, we can get a little bit deeper into market performance. And you can see here from the two charts that 2023, it's really been a continuation of the bear trend that started in 22. As mentioned, higher yields, wider credit spreads. Now, in the last quarter of 23, certainly in the IG sector, we did see a positive reversal. This is very much in line with what's happening in the US and global markets. The high yield segment continues to underperform a little bit. The concerns about China and particularly the property sector continue to weigh, but we did see this positive end to 23. Moving to the next slide. It's similar to primary. It's very difficult to talk about the Asia markets without looking at China. Even though China has decreased as a proportion of overall secondary activity, the offshore market, the China offshore market really continues to set the tone for the Asia international market more broadly. And the poor performance of the property sector, which goes back to the first half of 21, really weighs on the market. However, as we get towards the end of 2023, another factor to consider is the PBOC's attempts to create some kind of stability. And then we see this in the second chart, and really this ties in with the one that you were discussing from Bloomberg earlier. And here we see the southbound flows out of China. And from the middle of 2022, this again correlates, as we saw in the earlier chart, with the inflows, with the widening yield gap between US treasuries and Chinese government bonds. And this trend continues until the middle of 2023. But here we see a reversal. And the reason for this, and I touched on it a little bit earlier, we think is due to the fact that the PBOC was asking local banks to essentially reduce their outward investments. And this was largely to try and counter the yuan depreciation that we were experiencing. Moving to the next slide, one of the themes that we try to cover, particularly with the interviews, every year we do this. Actually, sorry, Mushtaq, can we go back one slide? And that's, to the e-trading slide.
Sure.
Okay, it's deliberately blank. And the reason why it's deliberately blank is because it is really difficult to get hold of data around how much is transacted through venues and what is the distribution across trading protocols. This information is a lot easier to obtain in the US and Europe. But what we hear is there is definitely a continuing trend to putting more volumes through various trading platforms. There's a lot more automation, both in terms of particularly the international banks in and price generation, and automation also from the investor side, and order flows. In terms of the trading protocols, not surprisingly, are the most popular by far. And this is essentially the electronification of the traditional dealer to client model. However, what we are hearing is that there is a lot more interest in other protocols, such as all-to-all, which opens up a wider pool of liquidity provision, including non-traditional market makers and liquidity providers, and also, interestingly, portfolio trading, where it's possible to basically get a quote for a whole list of securities as a contingent package. And both all-to-all and portfolio trading seem to have come into their own during these episodes of volatility, when best execution can actually be a driver for using these protocols rather than RFQ. Also related to portfolio trading, while still relatively nascent, the growth of the fixed income ETF market. PT then becomes really helpful in the creation and the redemption process. And we expect this to continue. Hopefully the next time we do this, we'll be able to show you some data. But as I said, it's very difficult to get. If we move on to the next slide, another very important part of the secondary market structure and dynamic is the ability to borrow securities. And what we found over the last few years is that it's reported that liquidity in the repo market continues to improve. We're hearing of more lenders coming into the market, which makes it easier for market makers to borrow specific names. Also, what we're seeing with higher rates, there's more on the table for lenders in terms of spread. And also the fact that Asia, perhaps unlike the US or Europe, there is not much tolerance for settlement fails. So you do see a very active specials market and some very expensive rates. For instance, we were hearing that certain Chinese property names in the international market trading from -2% to -20%, again, to be able to facilitate shorts. But of course, there's also a strong correlation between repo activity and the underlying market and secondary market activity. And we see this, I mean, here we have data from BondBlend on the left, which shows the volumes and the breakdown of the country of issuance. And again, if we were to overlay that with the earlier tracks data, you would see it correlates very, very closely. And then moving on to the next slide.
Oh, sorry. One quick question on that. Just curious about, so you're talking about credit, you're talking about different types of asset classes here. What about hedging of credit? So things like CDS, I mean, that's something that's always come up year to year. How have you seen the latest sentiment towards that and any important developments as well?
Yeah, as you say, Mushtaq, that's something we ask every year. It's the ability to hedge credit, particularly the CDS market, a very important part of market structure. In Asia, participants bemoan the lack of a really developed single name CDS market, which hasn't really existed for the best part of a decade now. There are only a few names a few credits that trade in the single name market, and only a few dealers who provide liquidity, making it very difficult to trade in and out. That said, there is, of course, the index, which is the iTraxx IG Asia ex Japan, which is very active. We have some data points in the report which reflects how liquid it is. It generally, and for 23, it was generally pretty good. It traded on an average of a 2 to 3 basis point bid-ask spread. okay, it's not quite as aggressive as its US or European counterparts, but it's fairly consistent. And similarly, at any one time, there are at least 6 or 7 dealers providing liquidity. So it's relatively liquid, relatively active, and does really provide a means of risk transfer during, particularly during episodes of volatility.
Right. So not so bad at the macro level, perhaps, but at the micro level, still challenging.
Absolutely, and also nothing nothing in the sense of high yield.
Understand. Okay. Outlook for 2024.
Yeah, just to wrap up from the interviews, and well, despite the challenges and the reduced volumes that we've just seen in primary and secondary, interviewees broadly optimistic. I guess we generally are as we go into a new year. But at the time of the interview, certainly at that February, March, we were beginning to see a pickup. China, of course, is a critical part of the equation. And there is some optimism that the PBOC will be able to both to stabilize the property sector while also stimulating economic growth. Again, we've moved on a little bit since March, but what we were observing then was lower US yields. And we thought that would, or the hope was that would bring more Asian corporates back into the international market. China, of course, but also India and as mentioned, Korea. And furthermore, the hope is that international investors who may have been burnt or may have been scared away by the volatility will return to the market. And also with increased supply, this will take some of the tightness out of the secondary market and provide a better value for investors. I'll stop there.
Thank you very much. Thank you so much, Andy. And I think also looking forward to new innovations in the market as well. So we at ICMA, we've been involved in some fintech developments with digital bonds. And we know that Hong Kong, Singapore, Japan, other jurisdictions are very much at the forefront globally in some of the new developments there. I think it's early stages, so we may be surprised at what we see. Also, the sustainable finance market continues to develop, and we, as Andy's mentioned, we do expect that e-trading and electronic trading platforms will continue to rise in popularity. Whether or not they transform the market immediately overnight, what impact they have on liquidity, I think, are still perhaps uncertain, but I think most of the people we talk to are indeed optimistic. So that's always a good attitude to have. Okay, great. So we've concluded our presentation. If there is any Q&A, now is your last chance to ask any questions that we may address in this webinar. Just a reminder that it is recorded. You will receive a link in due course with the recording, which you may share freely. We would love to hear your feedback on the paper. If you have any questions about the analysis or the underlying data, we can also help to answer those. So please do not hesitate to contact us. And one final request on my part, it's a lot of work for my CMA. We want to make sure that it's useful for the market. We want to make sure that it's useful for you as a market stakeholder, whatever type of firm you may be at. So if you have suggestions for additional fields of inquiry, threads of inquiry, or areas that you just don't think are that interesting, frankly, from the report, that's fine too. That will actually help us narrow our focus to what's most beneficial for everyone. So with that, one last glance at the Q&A. There's no questions there. So I would just like to close by thanking everyone for their time and for their interest. Oh, sorry, we have one more. We'll just pause a bit. Let's see. Okay, well, the question is, what is the outlook of the market participants on Indian issuers' international bonds? I can only speak from secondhand knowledge here. This is not my personal opinion, but I think the outlook is somewhat mixed in terms of international bonds. So I think overall sentiment about the Indian economy and the growth there and the policies of the government, generally speaking, are moderately positive. So I think that bodes well for the overall market. However, in terms of the fundamentals that we referred to, just in terms of price and meaningfulness for onshore issuers to tap the international market, that hasn't hugely changed. The onshore market is strong, it's robust, and most of the financing requirements are domestic in nature. However, I think there are two factors which could uh, could 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 help to increase issuance. One is the international funding requirements of many issuers, and second is the rise of sustainable financing, which makes offshore markets more attractive as well. So unfortunately, I can't be a crystal ball here. I think the issuance volumes from India have been relatively low certainly compared to the overall economy and the domestic market. But I think there is cautious optimism for growth in the short term. All right. Well, thank you very much for the question. If you have any further ones, please feel free to ask us. I will close there. And Andy, thank you again. Been a great partner to work with on this. Look forward to continued good work. And we wish all of you a happy evening if you're in Asia, or rest of the day if you're elsewhere. Take care. Bye-bye.